Hello and welcome to the 11th week of this course on financial econometrics. So today is the first lecture of the 11th week, that is where we are going to discuss the 50th lecture of this course. And in continuation of the last class, we will be talking about the volatility model. And today we will be talking about the stochastic volatility models, and there are the different extensions of this particular model. So let us revisit the last class quickly. So in the last class, what we have discussed, that a generalized version of autoregressive conditional heteroscedasticity model of order 1 and 1, that is where we have asked 1 and the Gauss term is also 1. So this is the structure we have discussed, that the mean equation and this is the variance equation, where this HT is the basically conditional variance at time t, and omega is the constant variance component, and alpha is the impact of the past squared residuals, and beta is the persistence of past conditional variance. However, what we can notice here, that here we have only error in the mean equation, not in the variance equation. So if we see the Gauss specification of this variance is completely deterministic. Why we have deterministic? Because we do not have any error term, and these are the parameters which determines the variance in this graph, which is a quite a restrictive approach. Uh, Here we are assuming that variance is deterministically determined. It does not depend on the stochastic component. So this is a very restrictive approach we are adopting here. So to overcome that, we are moving to the another model, what we call the stochastic volatility model, in which basically a second error term enters into the conditional variance here, this. So what are the advantages we will have because of this approach? First, this is a very realistic representation of the variance equation, because volatility varies stochastically. It does not follow a deterministic path, which we are missing into the Gauss model specification. Second advantage we have, or second relevance of this particular model, is that in case of risk management, it improves the forecasting, especially in the for the models like value at risk. Third relevance of this stochastic volatility model comes from the fact that in option pricing, we have seen that there will be the uh, volatility smile and skewness, that is the relationship between volatility and moneyness, which is not able to capture into the Gauss formulation. Here that can be captured through the stochastic volatility model. Third, what we have, the fourth relevant comes from the fact that in macro-finance relationship, where the uncertainty in the finance market is quite a common phenomena we are observing. Again, in the Gauss, that particular phenomena is not able to capture, so which could be captured through the stochastic volatility model. The fifth relevance comes from the fact that what we assume in the theoretical financial models, that the series is follow a continuous path. For example, if you take the stock prices, what we are assuming, stock prices can change at any time fraction. So we are not assuming it is an integer change. There could be a fractional change, that is the continuous price change is possible in the financial markets, which is the basically reality. However, in the Gauss, we are not able to accommodate that particular aspect, that is the continuous time finance. We cannot capture through the Gauss formulation. So that could be also able to capture through the stochastic volatility model. The another aspect we can look about the conditional and unconditional variance. So what is the conditional variance? For example, the models such as Gauss, when we are using, basically we are forecasting a conditional variance upon the information available up to time t. However, these historical volatility models are basically gives us a forecast of unconditional measures. So, and that generates a unconditional forecast. So now, due to this conditional and unconditional variance, what implications we have? The implication is that a short-term forecast, let us say one step ahead forecast, may be more accurate when you are using the conditional models, for example, Gauge or the different variation of the Gauge models. In such cases, because we are using all the informations available up to time t to forecast the variance of t plus 1 or at time t, that would be more accurate. However, when we are going to ask the long-term horizon forecast, then this is we do not have much advantage on that. Why we do not have much advantage? Because in the Gauge model, what we are assuming that stationary invariance. In that case, the forecast will converge upon the long term towards the average historical volatility. If that is the case, then for the long term horizon, let us say 20 step ahead, the Gauge forecast will likely have the similar forecast which we will be able to get through the unconditional variance. Then there is no much relevancy of the conditional forecast or the conditional models to have the long term uh, forecast of the variance. So these are the facts which reflects that the stochastic volatility models, even if not in general but in the certain situations, will have the better forecast, or it will be able to capture better variance dynamics than the conditional models such as Gauge and its different variations. So what is the stochastic volatility model here? So one of the simplest form of the stochastic volatility model is autoregressive volatility models. So you may recall from the univariate time series analysis where we have discussed about the autoregressive structure of the linear equations. Basically, autoregressive volatility models follow the similar structure which we have discussed in the autoregressive models. Only the difference is that here we are using the variable that is the observed volatility. Then using the simple similar Box-Jenkins type procedure, we will be able to estimate the volatility. For example, let us say if the quantity of interest here is a daily volatility estimate, then we can use the squared daily returns and use it and follow this particular structure to estimate the volatility here. So we can use the squared daily returns here, and through that we will observe the volatility, and based then following this particular structure we can have the volatility at time t. So if you see here, what is the difference we have? Here we have an error term nu t, which basically that is which follows a normal distribution with mean 0 and variance 1. So because of this, the nature of this volatility is now stochastic rather than deterministic. And that is the main difference between the Gauge, which we have discussed earlier, and this stochastic volatility model. However, this is a specific case or specific structure of the stochastic volatility models. The general form of the stochastic volatility models have the two components. One, the observation equation. Second, what we have, the variance equation. So the observation equations here, the similar like earlier we have that yt, which earlier we have used RT to represent. So if it is return, we could replace the YT as the RT. So this is basically return series. So this YT is the basically return series here. Then the main equation of this is mu and square root of Vt into epsilon t, where epsilon t follows a normal distribution. Now the variance equation depends on this structure of this particular term. So which is being modeled using this variance equation, where what we have log of Vt is equal to alpha plus beta into log of Vt minus 1 plus eta t here, so which follows a normal distribution with mean 0 and variance sigma square. Here this Vt is basically nothing the latent variance process. What we mean by the latent? We call it a process latent which is not observable. We are not able to observe, it is a underlying hidden process. So here we are assuming that the variance is following a latent stochastic process. The structure of that stochastic process is this, and this whole represent is the representation of stochastic volatility model, where we are modeling simultaneously the mean equation as well as the variance equation. Why we call it observation equation? Because this will be observed and which we are going to model. However, here Vt is a latent process, we are not able to observe directly, so that's why we call it the variance equation will be like this. Then the stochastic volatility model could be estimated either using the Bayesian estimation approach or the maximum likelihood estimation approach or the simulation based methods. When we are using the Bayesian estimation method, there basically we use the Markov chain Monte Carlo, which is commonly known as the MC approach, to estimate the parameters and the latent variables. In case of maximum likelihood estimation method, we imply the Kalman filter or the particle filter for the latent state estimation, which is basically not observable. So we will be using these techniques to estimate that latent process or latent variable. So once we estimate that, so this is the basically general stochastic volatility model. However, if we see here, in stochastic volatility model, only thing we are able to capture is that we are assuming the volatility does not follow a deterministic approach, rather than it is following an stochastic approach. However, there are the certain aspects which are not captured, or which we are not able to model using the stochastic volatility model. So there are the different extensions has been developed over the years to incorporate certain different aspects of the financial market. So one of the extension of the stochastic volatility model is jump diffusion model. So before that, let us say what is the diffusion model. So basically, diffusion model, what we call, where we assume that a particular process follow a continuous evolvement. So there is no break or there is no jump like the integers. It is a continuous process. Basically, we use the differential equations, not the difference equation, rather than we use the differential equation, assuming that the time is continuous. There is no fraction day or day 1, day 2, day 3, rather than it is a continuous process we have. So that what we call the diffusion models. So all those processes where we are assuming a continuous evolvement, for example, if you think of the stock prices, that is a continuous evolvement, there is no jump in that. And one of the diffusion model is the geometric Brownian motion. If you are modifying in that, then it becomes a jump diffusion model. So what modification we are doing? Basically, we are incorporating sudden and discontinuous changes into this diffusion model. For example, in asset prices, if let us say if there is the earning announcement, we can see there will be jump into the prices. If earning announcement is it could be either a positive change or the negative change, depending on what is the market view about the earning announcement. If the earning announcement is more than expectation, so then obviously there will be a positive change. If the earning announcement is less than the expectation, often we can observe there will be the negative jump. Or there could be some macroeconomic event or the geopolitical event which could create a jump into the stock prices. So if that is the case, then we need some this kind of jump diffusion models rather than the simple stochastic volatility models. Moreover of that, this jump diffusion model extension of this stochastic volatility models is also able to capture this fat tails and the skewness in the asset returns better than this traditional models. And we have seen that the fat tails and the skewness is the kind of stylized facts we observe in the asset prices across the market, across the sector, and across the different time points. So these are the observed phenomena in the financial markets. However, if you are relying on the traditional volatility models like GACH and all, then we will not be able to capture this phenomena. So this could be captured using the extension of the stochastic volatility model, what we call the jump diffusion stochastic volatility models. So how we formulate this? So to formulate this, what we use uh, the differential equation structure. So here D basically shows the different total differential of the ST, mu ST into dt. So this ST into dt is the this is the total differential of the ST, where ST is the basically asset prices at time t. Then this is mu ST into dt, sigma ST and dWt plus ST. So this is the structure of this jump diffusion model, where mu is the drift rate and sigma is the volatility of the asset, Wt is the standard Brownian motion, and Jt is the jump process. Now here our concern is primarily the jump component. So if you look at the jump component, what is the structure here we have? The jump component could be given by this, where this Nt is the Poisson process with intensity lambda, and this yi is the random variable representing the jump size, whether it is more than 0 for upward jumps and yi less than 0 for the downward jumps. And through this we are able to capture this phenomena, upward jump or the downward jump, here in this equation. So what are the features we have? The one feature, it incorporates jump. So it can, and another interesting feature, it is not only is able to capture the jump, it models both the continuous price changes and also the discontinuous jumps. However, in the earlier models we were able to capture only the continuous price change, not the discontinuous jump here. Flexibility of this model is that we can allow for modeling the skewness and the kurtosis into the return distribution if needed. Then includes parameter for the jump frequency, that is lambda, and the jump size distribution. So depending on the intensity and the absolute change, which captures the minus as well as the plus, it is basically we can calibrate to capture the asymmetry also into the process. Then it is very much applicable in the options, where adjusts the option pricing models to account for the rare events and the price shocks, which is not able to do into the traditional volatility models. However, there is the certain limitations we have. First limitation, it is quite complex for in estimation. So it requires very sophisticated numerical techniques for example, maximum likelihood estimation or particle or the Kalman filters. Computationally, it is intensive. So option pricing under the jump diffusion requires solving partial integral differential equations, which is quite intensive. Then the parameter sensitivity, highly sensitive to the choice of the jump intensity lambda and the jump size distribution, that is yi. If there is very marginal change, that could affect the total result. Moreover, in this case we need a large data set to estimate this jump components reliably. However, in the modern day, this data requirements is no more the limitations, because we have lots of data and high frequency data. So in such cases, the data requirements is now in most of the times is not a limitation of this model. Then we have another extension of this stochastic volatility model, that what we call the stochastic volatility model with the leverage. So leverage effect already we have discussed. However, what we basically here we mean by the leverage effect is that there will be a negative correlation between returns and volatility changes. That is, if there is the negative change into the price or the fluctuation is the negative, then there will be more volatility. However, of the uh, positive change of the same quantum will not have the similar effect. So that's basically what we call the leverage effect, which we have already discussed into the previous lectures. And this leverage effect we know is quite observable in the financial market, where we can say the bad news and the good news have the different effects on the volatility. It is often observed that bad news have more intensive impact on the volatility rather than the positive impact. Then this stochastic volatility models with leverage incorporates that into the data. And it has been also observed this model uh, is able to incorporate the leverage effect better than the other traditional volatility models. So basically what we do here, that we know that this is the standard stochastic volatility model, where this is the mean equation we have and this is the variance equation we have. So here basically we are including the error term. So this is now nothing but the stochastic volatility model. Otherwise we can, if we are adding the error term, then it becomes nothing but the Gauss 1-1 model. Now, in case of the stochastic volatility model with the leverage, what we are doing, we are introducing a correlation between the epsilon t and eta t. So, this eta is the basically here the random component into the variance, and this epsilon t is the basically error components into the mean equation. So, we include this, we find out the correlation between these two, that is the raw, then we include that the epsilon t decompose that rho eta t plus 1 minus rho xi t square, where this particular follows a normal distribution with mean 0 and variance 1. Now, here this epsilon t follows this particular structure into the mean equation, which basically reflects the leverage effect. Again, the same like the stochastic volatility models, we can estimate this particular model either using the Bayesian estimation or the particle filtering or the quasi maximum likelihood method or efficient method of moment. Any of these method could be used to estimate the parameters of the stochastic volatility models with the leverage effect. So what are the applications we have? We have the asset pricing, explains estimating the equity returns and the derivative pricing, which is quite often we observe. Option pricing, we can use this particular model for to model the volatility which goes into the option pricing, and that it will be able to capture the volatility smiles and the skewness in the option price markets. It also improves the estimation of the downside risk, for example, value at risk or the expected shortfall into the risk management. It also captures the uncertainty in the macroeconomic variables such as GDP or interest rate. So this is these are the some applications where we can use the stochastic volatility models with the leverage, which will have the better result than the other traditional models. However, certain limitations we have with this model. One, obviously there will be the computational complexity. Second, as like the stochastic volatility model with uh, diffusion, that is the parameter sensitivity will be there. Numerical stability, ensuring stability and convergence, numerical estimation can be challenging. Most often we fail to converge. Data requirements or the high frequency time series data for the reliable estimates we need. However, as we have discussed into the last model, in the modern day where we have large number of observations, the data requirements is no more a challenge or the limitation of such models. Then an interesting extension we have what we call the Heston model. So this Heston model is basically also an extension of the stochastic volatility model, which was introduced by Stephen Heston in 1993. And as we have talked, it is an extension. So basically it extends the traditional stochastic volatility model by making volatility itself a stochastic process. Rather than adding a stochastic term here, they are making itself a stochastic process. So why we are using that? The standard Black-Scholes assume that the constant volatility which fails to capture the real world features like volatility clustering or implied volatility smiles and skewness in the options market, which obviously we will be able to capture using the stochastic volatility model also, or the other gauge effect. However, this model provides a closed form solution for the certain derivative pricing, making it computationally efficient and widely used in the finance. So what is the structure we have? The structure, again, it depends on the stochastic differential equation. So here we have the same structure here as we have in the diffusion case. Then this is the asset price dynamics, that is the mean equation. Here we have the variance dynamics which follows this particular structure, where ST is the asset price, this VT is the variance, that is the stochastic volatility we have. As we have discussed earlier, this mu is the drift of the asset prices. Here the kappa is the speed of the mean reversion of the variance, and theta is the long run mean variance, here this theta term, and sigma v volatility of the variance, that is the volatility of volatility. So because here we are assuming this Vt is the volatility of this particular asset, and here this sigma v is the volatility of this particular volatility here. That's why we call it is nothing but the volatility which we have incorporated here. Then rho is the correlation between the two Wiener process, that is this one and this one. So rho dt here we have. So this is the mathematical formulation of the Heston model. What are the features we have? One, obviously it is assuming the volatility is stochastic rather than it is a deterministic. So it is a stochastic process against the assumption of the gauge, where we are assuming the volatility follows a deterministic process. Second, it is a mean reverting variance. It also captures the leverage effect by incorporating the correlation term. Third, it gives the closed form solutions, and rich dynamics captures the implied volatility smiles skewness observed into the real markets. So it is able to capture the various dynamics of the volatility which we are observing into the financial market. For example, it is able to model the stochastic volatility. It is also able to capture the mean reverting variance, that is in the long term it reverts towards the long term average. It is also able to capture the leverage effect, and it is also is the closed form solutions we have. So these are the features of Heston model we have. However, it is a very computationally intensive model we have. So estimating these parameters can be computationally intensive. The design for, however, this has very one specific limitation, that this is designed for the European options. There is uh, not extension. We cannot use this model for the American or exotic options. Numerical challenges: integration is required for the computing option prices. Then the model assumes the constant interest rate and the dividend of yields, which is not true in the real world. So today we have talked a different version of the volatility models, that what we call stochastic volatility models, and we have seen that how this stochastic volatility model is a improved version of the GACH 11. However, it is the major limitation we have. It is very computationally intensive, and it needs a lot of calibration for the optimization. So the estimating the parameters of this model is quite challenging. In the next, we will see the multivariate form of this volatility models, where we will be first discussing about the multivariate gauge models. So thank you so much. Hope you are enjoying this particular course.